If you care about protecting your money, you need to hear this. Silver just printed $125 per ounce in Shanghai, while the U.S. market is still sitting around $110. That spread is not normal. That's a warning flare. We're only a couple hours into Asia's trading session, and silver's already moving like something just snapped behind the scenes. This isn't a nice rally. This is the kind of price action that shows up when the physical market is under pressure. Quick note, if you want real-time alerts and the next plays I'm watching, follow this channel now. Now, let's break down what this means. Here's the situation. Shanghai silver, about $125. US pricing, around $110 to $109. That's a premium of roughly $15 to $17 per ounce. That kind of gap isn't volatility, that's a pricing fracture. Because in a normal world, that gap gets closed fast. Traders buy silver where it's cheaper, move it to where it's expensive, and the prices come back together. But if the gap stays wide, it tells you one of two things. Physical supply isn't moving fast enough, or physical supply isn't available in size. Either way, it's not a paper story anymore. It's a delivery story. This is the physical market sending a message to the paper market. Your price is not the real price. And if this continues, it means the West is still trading silver like a financial product, while Asia is treating it like a strategic resource. Remember, China is one of the biggest industrial consumers of silver on Earth. Silver isn't just money, it's a critical metal for solar, electronics, EVs, and high-efficiency infrastructure. So when Shanghai is willing to pay up like this, it's usually because the buyer doesn't care about price, they care about securing supply. That's a completely different mindset than a speculator chasing a chart. Here's the part most people are missing. This is happening while a lot of Western money is still asleep at the wheel. If U.S. funds and big institutions start waking up and chasing this move, you don't get a smooth climb, you get a violent repricing. So what happens next from here? Scenario A. The premium collapses. Temporary squeeze. Shanghai cools, supply loosens, and the gap shrinks fast. Scenario B. The premium stays elevated. Structural problem. That means physical tightness is real, and the true price starts pulling global markets higher. Scenario C. The premium widens. This gets historic. If Shanghai keeps bidding up while the West tries to hold price down, you risk a situation where the paper system loses credibility. And that's when things get chaotic. Now, I'm going to be real with you. Silver can snap back hard. Things that can cool this off quickly, profit-taking after a huge run, margin hikes in futures markets, sudden dollar strength, or big players stepping in to cap the move. Silver is not a beginner market. If you can't handle violent swings, don't play it like a casino. But here's why the bullish case is getting stronger. Global inventory pressure, industrial demand growing, supply chains fragmenting, physical metal becoming more valuable than contracts. When the world stops trusting paper, physical becomes king. And that's exactly what a Shanghai premium like this is hinting at. Here's the smart way to move. Don't chase like a maniac. Expect pullbacks. Silver always breathes. Watch the premium all week. Watch physical availability and retail premiums. If you're holding physical, understand why you own it. Because this isn't just price movement. This is the market revealing stress. A $15 to $17 Shanghai premium is not normal. If it persists, the global silver price mechanism is changing. Physical demand is starting to overpower paper control. This is exactly how major resets begin, quietly at first, then all at once. If you want calm, serious breakdowns while this unfolds, subscribe to OG Mike. We stay ahead of the crowd.